what do you see as the greatest opportunities, both for yourself and your company, and then for any of your investors? Because I know you're raising the fund right now, but where do you see the opportunity for investment right now?
Well, let me start off with storage. I'm going to spend like 60 seconds on it, right? And then I'll switch into the industrial. So on the storage side, we're going to keep doing the development that we're doing because I'm going to try to find more. One of our goals is to try to reach out to people that attempted doing the development, or they've gotten somewhere in the process of maybe getting the permits approved or close to it, but are now stopped. We still have funding, and are able to do deals. And we know from the history, 2008 and prior, that usually there's a bit of a slowdown on storage. Meaning, let's say in 2008, from 2008 to 2000, middle of 2009, first thing that people do is they say, "Hey, what do I have in storage that I don't need?" And they cut it. Right? So you lose a little bit of occupancy. But then as people start losing jobs and foreclosures kick in and they start downsizing from a large house to a small apartment, they're losing the most valuable asset that they have in their life. They don't want to lose their personal stuff. So if they're moving from a place where they were paying $4,000 a month, on a mortgage, or $3,000 a month, and now they're moving to something that's half the cost or less, right? They don't mind spending extra $100, $120 a month to keep their belongings. And oftentimes the belongings are, worth in excess of $100,000. If you have a nice house and you look at all the stuff you have in your home, it quickly adds up. And then there's part of sentimental stuff. So like I've seen it from 2009 to 2014, the occupancies, the self-storage, the occupancy just skyrocketed and the rates did as well. And part of the reason is because other people stopped developing. So, and there's no new product coming online, right? People can't get financing. We're backed by a couple of insurance companies. One's a $100 billion company, another one's a $40 billion company. We have a good investment base. We believe in our product, and we're going to keep moving. But where we see another part of where we see really big opportunity, I'm gonna digress a bit, and it's almost surprising how COVID affected it. In 2009, online sales were 6% of all the retail sales. In 2019, online sales were 16% of all the retail sales, and so the business almost tripled. Over a course of 10 years. Now, for those of you who don't know, and I didn't know before I was in the business, when retail shifts to online, okay, you actually need more real estate. You actually need, for every square foot of retail that you don't use, you need 3 square feet of warehouse space. Because you instead of having goods coming from the distribution center to the store, and having several stores in the area, the goods are now going from a distribution center to a multi-city distribution center, possibly second multi-city distribution center, and then they're going to the warehouse next to the city. It's not several stores; it's now one store, or maybe 2 in a really large city on 2 sides of the city. And what ends up happening is online shopping is the return economy. A simple example is that when I buy shoes, I wear size 10.5. I buy 10, 10.5, and 11, because you never know, right? Different models of different sizes. I try on the ones that fit me the best. And if I like them, I keep them. I keep a pair and I return 2. If I don't like them, I return all 3. So 50% of all the orders are returned. The second thing with online shopping is it's not like a store. It's not like you're going to go there and see a pair of shoes that you want. If they don't have your size, you'll say, well, I'll come back next week. No, you'll flip to the next site and buy it on the next site. So they need to stock more, and they're not limited by shelf space. Now, the good news for the stores is that warehouse space is a lot cheaper. And I'll use 2 examples. Chicago Magnificent Mile, annual rents on retail are between $500 and $600 a year, right? Versus industrial, A-class industrial is about $25 a year, right? So the difference is massive. So you're saving Yes, you need 3 times more space, but it's not that expensive. Retail in Montreal and on a nice street runs for 90 or $100 a square foot. Industrial runs for 10 or $12 a square foot. So yes, you're getting rid of some space, you're reducing some employees, and now you're putting a forklift guy and a shipping guy in a warehouse, but you do need more space. And one of the things that's happened since 1970s, US, from through 40s, 50s, and 60s, US was heavily industrial. Starting from mid 60s, 70s, and 80s, all the industry left and went to South America, Central America, and then later on to China. And these industrial areas were sores in the cities, and cities that worked really, really, really hard. I'm sure same cases in Boston, Chicago, New York. They worked really hard to gentrify these areas and to turn the industrial areas into residential areas. Hence, we have loft, right? Hence, loft everywhere, and they've turned that into retail centers. And now, what's happening? We have a surge in the demand because this economy is driving e-commerce. The growth from 6 to 16% is putting stress on industrial because there aren't enough industrial places. They're zoned industrial. The zoning is not there for industrial, and getting zoning approved for industrial is very hard in major cities. They were against it for a long time. So that's the challenge. That there's already not enough supply, and there's a lot of demand. And now this COVID happened, right? And overnight, the 16% grows to 40%, right? So what took the 250% growth that took 10 years has just happened in a month and a half. And now, do I believe that everyone's going to keep shopping online as much as they are right now? I don't believe so. But what I do know is that prior shoppers online were people middle age, meaning like younger and middle age, and people in middle and upper income classes, right? People with lower income did not shop online, and people that were older didn't shop online. Well, now older people and people lower income levels are being forced to shop online, and they're being trained to do so. So when we go back to the new normal, do I believe that we're going to remain at 40 or 40 something percent that we're at right now? No, but it might end up being 30 or 25. And damage demand is going to put huge stress on the supply of industrial. Now, what I believe is going to happen short term, and we're specializing in logistical, the e-commerce stuff. So what I believe is going to happen in short term, people are going to start losing their homes. They're going to panic, and they're going to sell their industrial for less than market value, right? Because the other real estate's shaking. They might lose a tenant. If they don't replace the tenant quickly, there's a lineup of tenants, but people will get cold feet. There are less buyers out there. What we just discussed. When a lot of people are tracked and see what's going to happen, we want to go in there and buy at a discount. So we're looking at 25, 30% discount to the previous value, where we can go in and buy something and get 12% cash on cash right away, in addition to the mortgage pay down, in addition to some, growth. So, this is an opportunity. We feel that it's going to be a rather large opportunity. We're going to launch a fund soon, but we won't start buying until people start going back to work. And when they do, we'll launch, 30 million equity and maybe 50 million in financing. We don't over leverage, and we'll launch the first fund. We believe we'll get through it in like 9 months to a year, and then we'll launch a larger fund, maybe 100 million equity and slightly more. And maybe another 150 million in financing. So that's the name of the game, right? For us at least. So I think opportunities are out there. I believe like retail is going to suffer for a little while. I also do believe that retail in like the best locations in the country is actually going to do better than before, because the new model for the stores is to have a showcase store, right? Somewhere where you can go and try something on, and then you can buy the rest online. So I believe the showcase stores are going to be there. Amazon is opening up showcase stores,
Mhm.
but they're opening them up at the best locations in the country. So I believe that real estate is going to go up in value, and it's going to survive and it's going to go up in value overall. I believe the retail in secondary, tertiary locations is definitely going to drop off, and maybe 4 or 5 years down the line, we're going to start lobbying for it to try to convert some of the retail shopping centers into last mile e-commerce centers, but then there's a zoning change.
Mhm.
So if you're talking about Boston, New York, and Midwest too, to get a permit on a new construction in commercial, it takes you a year and a half when zoning's right? To change the zoning is a few years. So that's a longer term game. So we'll focus on what's here now, and then long term 5 year goal is to try to acquire some retail spots and change the zoning. So that's our side of the story here. As far as the investors, there's never been a better opportunity to buy into a market that's growing at a better price. So prior to the COVID, these things were trading at like 5.5 and 5.75 cap. We're looking to buy. We're starting to make offers and getting accepted at like 8, 9 caps, and the rates have never been lower. So the spread between what we're paying on interest right now, we're getting on industrial at least, we're getting a 10-year fixed at 3.6 or 3.5. We've seen some offers at 3.335. So if you're borrowing money at 3.6 and you're running an 8 cap property, those spreads have never been larger. Like there's never been more profit in it. So I think the industrial is going to be the first one to recover. The second one's going to be storage. I do feel that office game is going to have to change. I don't know what's going to happen with it. I believe multifamily is going to suffer, especially Class C. There's going to be I think Class C is overinflated anyway. I think there's going to be a reset on what it needs to be valued, and some people are going to lose property. So I believe that there's a multifamily opportunity, but not today, right? Multifamily opportunity maybe in 2.5 years from now, and then 4 to 5 years retail. And then hospitality, I don't know. I believe what Mike said earlier prior to the call, hospitality, maybe in your local market, if you focus on stuff that local people will be interested in, is more short term, and then long term, I don't have a crystal ball.